Hello guys and welcome to Crypto Tech. Today I'm going to show you a money management strategy that will potentially make you a ton of money. And I'm going to explain to you why this strategy is far more better than the 95% of the people's strategy that everyone is talking about. So make sure you stick around till the end of this video and let's get started. Okay, so we're currently looking at the price of Cardano USD 4-hour chart. And here's the current price, sitting at around 9094. 74. So we have this indicator on our chart. This is a SSL channel and here are the inputs. Alright. So, the way this indicator works, is whenever you see these lines crossing each other and the red is above the green one, this is a short signal. And same works for a bullish trend. The green is above the red one. This is a bullish signal. Okay, now let's just take a look at this signal right here. This indicator tells us that this price at 1.0701, this is the best price to enter a short position. What would the majority of traders do in this case? Even if they had this indicator in place or if they didn't have this indicator, they would just draw some support and resistance lines and they will figure out this entry somehow. But let's say here's the entry. Where would they put their stop loss? They would probably draw a resistance line somewhere here. And this is the area where they would put their stop loss at. And let's just take a look at the price range. And that is roughly 40 pips away, or 3.83% loss, in case if the price moves against them. So now let's take a look at where the take profit level is going to be at. So normally what they will do, they will put 2-to-1 ratio. So that's going to be at roughly 80. Okay, so here's the take profit level. Everything looks logical, 2-to-1 ratio. Everyone is talking about this, so you might as well probably use it. However, there is a problem with this strategy. What happens if the price, for example, keeps moving in your favor? You just capped your profit and now the price is moving in your favor. What happens if the price, you entered somewhere here, the price, for example, went all the way down here and then you had a pullback and the price hit your stop loss. Now you lost the trade, even though you were winning. That's why the number one rule in trading, if you really want to make some good money, you not just want to be a break-even trader or a losing trader. What you want to do is you want to let your winners ride. You want to cut your losses as soon as possible and you want to let your winners ride. So now let me show you a different approach. Let's just get rid of these. Okay. First of all, we're going to place our stop loss based on this indicator. Average true range. So what this indicator does, it takes into account the last 14 time periods and it calculates the average length of a time period of the candlestick. This is a very important indicator because it shows you the volatility of the market. So the current value sits at 0.033. So if we take a look at the price range of an average candlestick, so it's sitting at 0.037. So this is pretty much an average length of a candlestick that happened during this time period. So now let's take a look at the value of the ATR whenever we enter the trade right there. So it sits at around 0.025. So we want to keep this number in mind because we're going to use this ATR in order to figure out our stop loss level. So now what we want to do is we want to put our stop loss at 1.5 value of the ATR. So in that case, if it's 0.025, that's going to be 0.038 roughly. So it's going to be somewhere here. Okay? So this is our stop loss. Okay, so we enter the trade. We set our stop loss at 1.5 value of the ATR. Now we wait. Now we wait until the actual price moves in our favor and hits the two values of the ATR. So in that case, that will be, so let's have a look. 25 times 2, that is 50. Okay? So 50 is two values of the ATR. Let's just make a note and write down all these numbers so you don't get confused. What we need to do is we need to write down three numbers. What is the value of 0.5 ATR? So our ATR is at, let's say, 25, 0.5 value. That's going to be 0.013. 1.5 ATR, which is our stop loss, is at 0.037, just like we said. Now we need to know the two ATR value. And that is, so if the ATR is 25, 2 ATR value, that's going to be 50. 0.050. Okay. So we have our notes here. This is a 2 ATR value. Here's the price. Before entering the trade, you need to set yourself an alert so that you know when the price actually hits this 2 value of the ATR. This is very important because at this point, what you want to do is you want to move your stop loss from here, from 1.5 ATR, from this distance between the entry price and the stop loss. You want to place it all the way down here so that the distance between the current price and your stop loss is exactly 1.5 value of the ATR. Which in that case, we need to put this distance as 0.5 ATR. That is 13. I hope this makes sense. So now we have our stop loss moved and we're pretty much playing with our profits. We're not losing anything. Now if the price, for example, moves against us and hits our stop loss, we're still going to be in win of 0.5 ATR or 1.27% of gains. We're not losing anything at this point. So now this is very important. What you want to do is you want to scale out. Every time the price moves lower in your favor, you want to adjust your stop loss. So it's like a trailing stop loss. So for example here, the price moves against you. You do not want to change your stop loss. You just leave it there. The price moves against you. There you go. It didn't hit your stop loss. It didn't hit your stop loss because your stop loss is all the way up here. Moves against you and then boom, it's right here. Pretty much at the same level where it was. And then next candlestick, boom, it drops all the way down here. So now what you want to do is you want to calculate the distance between the current price and your stop loss. So that is exactly 1.5 ATR. This is how you scale in. So now the distance is, I don't know exactly, but if you take this number right here, 65, minus this number, 37, 1.5 ATR, that's roughly going to be at 28, I reckon. Yeah, 28. So let's move our stop loss all the way down to 28. So now we have exactly 1.5 ATR, the distance between our current price and the stop loss. So now you have a bigger win right here. See, that's how you scale in. And the price moves again. You adjust the ATR right here again. And now it moves against you and then boom, this big drop happen. So what you want to do, you want to adjust your stop loss again. So it's at 86. So 86 minus 37, that's going to be 49. That's 49. There we go. So now you have 4.67% gains. This is your profit pretty much. And now you're playing with your profits at this point. So the price obviously does a retraction. It doesn't hit your stop loss, as you can see. There's still plenty of room. You want to make sure that there is plenty of room. That's why you need to put a 1.5 ATR as your stop loss. So you let the trade, you let the price breathe. And now what happens here? Boom. Drops all the way down to 0.97. Now, 97 minus 37, that is 60. Move your stop loss all the way down to here. 60. And so on and so on. Now, for example, it dropped all the way down here. Yeah, you kept adjusting it. And by the way, you need to adjust your stop loss every time there is a new candlestick. So if at the moment we have a 4-hour chart. So if you're trading 4-hour chart, every 4 hour you need to adjust your stop loss if the price moves in your favor. So that's how you scale in. And there we go. Now we're sitting at 138 minus 0.037, and that is roughly 100 pips in our pocket. There we go. So, of course, we're going to have this retraction and the price eventually hits our stop loss. But we made all this win right here. So let's get rid of this. So now you see we gained 9%, 9.45% on this trade. So now let's take a look one more time at that 2-to-1 ratio that everyone is talking about. So if you had entered somewhere here, there's a stop loss at 40 and our take profit would be somewhere at 80. So there we go. 7.43% gains. If the price hits your take profit level, it doesn't go back, it doesn't retract and hit your stop loss. Comparing to 9.45% guaranteed gains. These gains are guaranteed. If the price keeps moving in your favor, these gains are guaranteed. These gains are not guaranteed. So let's, for example, take this Elliott impulse wave and see. Okay, so this is the entry price. Here's the take profit level. Obviously, you weren't adjusting the stop loss. You just kept your stop loss right there. You didn't move it, and you just waited until your price hits the take profit level. Okay, so let's just assume it didn't. Let's assume the price went all the way down here, close to your take profit level, and it reversed. Yep. 1, 2, 3, and it hits your stop loss. So now you had a winning trade that actually went in your favor, but because you are really bad at money management, this is what happened. The price hit your stop loss. So, I hope this video was really helpful to you. And if you want to see more videos like this, please subscribe to the channel and see you in the next video.